Welcome to Taking Stock for the week ending the 26th of August 2022. I'm Trinh, and today we are joined by our new Equities Analyst, Daniel Ortisi, to strengthen you all things share market. Now, Daniel has been with us since June and covers star stocks within the mining and real estate sectors. Thanks for joining us today for your first Taking Stock, Daniel. I know that how busy you are with the reporting season, but I'm sure members are appreciative of your dedication and late nights.
Yeah, definitely. Thanks, Kien. Great to be here today and also with the Lincoln team.
But before we get started, just a reminder that the information presented today is of a generic nature and therefore shouldn't be considered personal advice. Shares are volatile, so any charts and tables presented should not be relied upon as a guide for future performance. Well now, last week, we alluded to the resilient profits and attractive dividends emerging over the Australian reporting season, despite the supply chain pressures and cost inflation. Overall, about 69% of companies have met or beaten market expectations. And although this is slightly lower than last week and the historical average of around 72%, it's nowhere near the doom and gloom anticipated by the market when it dropped so sharply last month. So Dan, what is your view of the reporting season so far?
Yeah, that's right. Well, firstly, Kien, we need to remember that results reflect mostly the strength of the economy and elevated commodity prices for the first 10 or so months of last financial year. Looking ahead, though, many companies have been quite cautious with their outlook. However, the data from trading updates, especially across the retailers, have shown little signs of consumer stress from rising interest rates, which suggests that the economy could be in for a soft landing.
And during this reporting season, the key metrics that really have defined those quality businesses from the ordinary ones are the high profit margins and the robust earnings quality. And overall, margins have held up reasonably well, in part because those companies with strong market positions, they've been able to push through price increases without really impacting volume. Meanwhile, companies have continued to utilize their cash flows to build up inventory and to manage these supply chain constraints.
Yeah, that's right, Kien. An elevated inventory level helps manage the supply chain risk, but leaves companies vulnerable to write-downs if the products are not sold in a timely manner. A reduction in cash flows can lead to weak earnings quality, as was the case with ARB Corp, or it can even impact the financial health of a business, as this was demonstrated with our removal of Breville Group. However, we will touch on this topic a bit later on.
Yes, and the reporting season, it allows you to quickly assess the financial health of the business soon after the release of their results. And it also helps you avoid stocks like, for instance, EML Payments, which have been punished by investors after the company was hit by fraudulent activity within its recently acquired business, Centennial. Now, the impact has led to significant downward earnings revisions on the stock, with short interest elevated at around 8%. And although it can be difficult to detect fraud at times, investing in financially healthy businesses does mitigate this risk.
That's right, Kien. And speaking about risks, one of our long-standing borderline star growth and star income stock, debt collection house and loan provider Credit Corp, was sold down this week after the company revealed an administrative oversight. Essentially, they were charging clients on zero interest accounts. This issue could potentially weigh on their earnings by about 4%, with negative earnings revisions already flowing through. Despite this, management have come out and reaffirmed earnings guidance, with consensus anticipating earnings growth to be flat this financial year.
Right, but Credit Corp has been our long-standing growth stock. And speaking about those growth stocks as well, remember they were sold down over the last month on the back of rising interest rate concerns. But this didn't really dampen the earnings potential of star growth stock and circuit board design software firm Altium. In fact, the ongoing global semiconductor shortage means that there was a greater demand for Octopart, and that's a search engine used for spare electronics parts.
Yeah, and meanwhile, demand for Altium's core design software remains strong as it invests in its cloud-based platform, Altium 365, allowing the company to generate 75% in recurring revenue. This helped Altium report improved net profit margins to 25%, with a return on equity at around 22%. The outlook remains promising, with the market anticipating double-digit earnings growth over the next 2 years. This is expected to be driven by strong demand for electronics on the back of 5G communications, electric vehicles, and the increasing use of data science and AI.
Yeah, it's a very strong thematic there, Dan. But onto another promising tech company with a really good thematic is borderline star growth stock and logistics software provider Wisetech. Now, over the year, pressures on those global logistics industries have led to rising demand for their software as companies aim and they seek to improve efficiencies within their supply chain. And even though Wisetech has updated the market in July with an earnings upgrade, the stock did react quite well to the result after the company released a bullish FY23 outlook, which was above market expectations.
That's correct, and investors may be concerned that the stock is trading at a premium to consensus targets and at a price to earnings multiple of around 84 times. However, this is not unusual for a growing technology company, which has historically traded at high valuation multiples in the past.
And it's also positive to see that the CEO, Richard White, he continues to hold a significant stake in the business at around 38%.
Yeah, that's right, Kien. And along with Wisetech and Altium, there were many other stocks that reported during the week. And you can keep track of this by referring to the recent updates page. Some of the interesting names for me were Domino's Pizza, Woolworths, IDP Education, ResMed, and APA Group. As we head into the close of reporting season, you can refer to our corporate calendar for a list of upcoming results. Some highlighted names next week include retailer Lovisa, salary sacrifice business Macmillan Shakespeare, and drilling services company DDH1. There will also be a few resource stocks releasing their results. For income investors, key stocks going ex-dividend include BHP, Woolworths, Credit Corp, Wesfarmers, and Perpetual.
And this week, we put the spotlight on ex-borderline star growth stock and appliance manufacturer Breville Group. The stock has been a strong performer since it was introduced as a star growth stock in August 2018. And although it's sad to see it go, we invest in an objective framework and don't really have any emotional attachments to stocks. At face value, the company reported a seemingly strong set of results with earnings growth at 15%. And this helped to sustain its return on equity at 19%. The performance was driven by new product launches and strong sales in the US, which offset a slowdown in Europe as consumers reacted to the war in Ukraine. Now, the company was able to keep its net profit margins relatively steady at 7.5%, despite higher freight costs by increasing prices by around 5%. However, why did the financial health deteriorate so much, Dan?
Yeah, well, Kien, to help manage supply chain bottlenecks, the company more than doubled their inventory to 446 million to alleviate any stock availability concerns as Breville head into the busy Christmas trading period. This led to a contraction in operating cash flow from an inflow of 124 million to an outflow of 42 million. In addition, the balance sheet reverted to a net debt position from a net cash position previously. These factors collectively shifted Breville Group's financial health rating from satisfactory to marginal.
Yeah, quite concerning there, but also the deterioration in cash flows led to an extension of its weak earnings quality rating as well. And this really reflects the fact that cash flows are not consistent with its reported profits. We had really hoped that the earnings quality would improve over the year, but supply chain pressures remained quite an active risk at the moment.
That's right, Kien. And additionally, the buildup of inventory means that Breville is vulnerable to discounting and stock write-downs in the event of slower than expected sales, especially if interest rates continue to rise for the remainder of the year. Management have stated that they will buy less stock in the future instead of selling products at a discounted price. But the outlook is still highly uncertain, especially with its exposure to a deteriorating European economy. The risk is evident with the level of shortages rising to over 6% in the last few months.
Yeah, and you can see that under Golden Rule 4 in the charts, but investors holding the stock should be mindful that it is now very high risk with negative operating cash flows. And although it's considered a high quality retailer with a strong brand and innovative products, we have had to remove the stock from coverage until we see evidence of a turnaround in its cash flows and financial health. During the reporting season, companies usually inform investors of when dividends are paid. So an interesting question for investors this week is, how can I track the ex-dividend date for my stocks using Stock Doctor? Well, the ex-dividend date is the date that an investor needs to hold on to the stock before receiving the dividend payment. Usually on this day, the share price will fall by roughly the dividend amount, assuming all else is equal. In other words, you are giving up your capital return for the same amount in income. But the benefit of holding your stock until ex-dividend is that you may also be able to extract a franking credit as a bonus.
That's right, Kien. And to help you decide whether you want to hold a stock leading into its ex-dividend date, you can view the historical share price reaction around a stock's ex-dividend date by using the advanced charting tool. Enter in your stock, then a time period of at least 5 years, and finally select the ex-dividend dates under the Events tab on the left.
Yeah, that's a really good history there you can find to understand whether share prices can recover after ex-dividend dates. But within Stock Doctor, you can also see the ex-dividend date in the 9 golden rule screen in the income criteria section, or you can view it under the drop-down box at the corporate event bar near the top. You can view the history of dividends and ex-dates by clicking on the dividend tab. Here you'll be able to see a few comparison charts, the forecast dividend yield, payout ratio, and also days until ex-dividend date.
And to look for upcoming opportunities, you can also view a list of stocks with upcoming dividends under the pending dividends section. And also within the watch list tool, by using the income view, you'll also be able to sort the column by upcoming ex-dividend date. Or you could create your own filter using the stock filter tool and screen by using income metrics.
And finally, you can also set alerts under the notifications section to inform you via email if your ex-dividend date is approaching. Remember, dividends are essential for income investors, and Stock Doctor makes it easy for you to monitor your dividend events throughout the reporting season. And if you have any questions, feel free to contact our client services team. Thanks, Dan, for your insights today. It will be busy for you next week with some of those gold miners and energy stocks reporting, but it's been great to have you on board, especially for our members who can now put a face to your commentary.
Thanks, Kien. It's great to be here and hopefully be joining you soon for another episode.
And this week we have released our Mastering Stock Exit and Re-Entry Strategies video located in the Resources Center under Stock Doctor Education Videos. So jump on that to help you understand the portfolio strategies we offer. Also, with reporting season, it may be useful for you to attend our Lincoln Live webinar on Monday, where we talk about market strategies and answer your questions on stocks. To summarize, although many companies are reporting strong profits, pay attention to the cash flows and the balance sheet debt. This can drastically change the financial health of a business and increase the risk to your portfolio. Take care and have a happy, healthy, and prosperous week, everyone.